Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show. Yes, I'm back after 2 weeks. It's nice to be back. It's been one thing to have surgery, but now, it's like after a few days of being hanging around the house. I feel you. Brent and I have been very fortunate during this whole COVID lockdown thing because we had to get out of our house to come to the station to broadcast, right? And so look, if you've been locked up in your house for like 3 months, I sympathize with you now. I get it. 2 weeks was enough for me. So glad to be back on the show with you this morning. And interestingly enough, after 2 weeks, nothing's changed. I left here talking about the fact we weren't going to have fiscal stimulus before the election. We had this contested presidential debate still coming up. And here it is 2 weeks later, still no fiscal stimulus. It's still a contested election. And Joe Biden's apparently running for the Senate. So, this is absolutely nothing's changed here.
One of the mistakes that President Obama made with the Affordable Care Act was putting pre-existing conditions into the normal risk pool. Now, if you don't understand this is the whole problem with why your health care costs are so high. Insurance is a risk pool. Insurance was started back hundreds of years ago to cover shipments of goods. And what merchants would do is they would take out insurance on a shipment of goods on a ship because ships had this really nasty habit of being swallowed by sea monsters and going down in the middle of the ocean and the merchandise not making it to its destination. I mean, these are old wooden sailing ships, so they sank all the time. And so insurance was taken out to insure the cargo. A lot of times the cargo would make it, so the premium that was paid in to cover that cargo was kept by the insurance company. So, and this process went on. So more often than not, the shipment got to where it's going, but every now and then a ship would get swallowed by the giant squid, right? And the insurance company would have to reach into that pool of money that they had been collecting on insurance that they didn't have to pay out on, they have to pay out on it. Okay, that's insurance. So it's a risk pool. You pay for risk. The way insurance worked previously, and the reason that healthcare costs weren't as high as they were previously prior to 2009, was because the risk pool was healthy people. And this is the way insurance works. We have a pool of people that are all paying into a pool of money, and nobody's sick. And this may go on for years. And so the insurance company is raking in all this money. And because they're bringing in so much money but not having to pay out, your premium's not very high. You're paying a little bit for the potential risk that you might get sick down the road. So the insurance company's bringing in this money, these small premiums, but it adds up over time. And then eventually somebody in that pool comes down with cancer. And there's $1 million payout to cure that cancer, whatever it is. That's okay, though, because the pool, that's what the pool was for. It was accumulating money over time to pay out for this potential catastrophic incident that eventually occurred in the pool. The problem with the Affordable Care Act is that you took sick people and put them into the same pool. So immediately, as soon as I took a sick person with a pre-existing condition and put them into a pool, immediately that pool has to start paying out money to cover their illness. So when you stuck a whole bunch of people with pre-existing conditions into the pool, the insurance, and we said this, right? Brent and I were talking about this, and we were interviewing doctors. We said, as soon as you do this, your insurance premium is going to skyrocket. Why? Because the insurance company has to say, look, if I've got to immediately pay out, I don't have time. And see, insurance is about time. How long is it going to be if I start collecting a small premium? Say I'm going to pay $100 a month, $1,200 a year for my insurance. How long is it going to be? 10 years, 15 years, 20 years of collection before I have to pay that money out? Well, as soon as you put somebody in that's sick, immediately you've got to start paying it out. So premiums had to go up. We've been saying for a while that you should avoid bank stocks in your portfolio. There's a lot of problems fundamentally with bank stocks. JP Morgan, Bank of America, all these guys. First of all, they've been underperforming by a large margin, which makes them less attractive. But fundamentally, they have problems as well, which is, look, low interest rates are not good for banks. Banks make money by loaning money. They also make money by trading stocks. And that's been the one thing where they've been beating earnings is by creating revenue through trading equities, right? Pushing up financial markets. But in terms of their actual core business, it's not so good. Lending standards have tightened up a lot. Mortgage loan applications are being rejected by a large degree. People have more tougher time qualifying to get loans. And this is how a bank makes money outside of trading revenue. But one thing that they did going into the pandemic was increase loan loss reserves, setting aside money to pay for losses on debt. Somebody doesn't pay their mortgage, defaults on their credit card, whatever it is, that's what the money's for. So they set aside this money in the last quarter to offset these loan loss reserves. Well, here we are a quarter later. The economy is really not all that much better. You still have a eviction moratorium that's going on at the moment. There's a lot of individuals that are not paying their mortgages and have no ability to pay their mortgages. And ultimately, without more stimulus coming in, there's going to be a shortfall of incomes, which are going to lead to rising credit card defaults and, a variety of other non-payment issues. But yet, JP Morgan collapsed their loan loss reserves by 94% yesterday in their earnings. So basically, they took all their loan loss reserves that they had set aside, they put it back on their books. That's how they beat earnings yesterday. Bank of America, exactly the same thing today. When they announced earnings, basically their revenues were down sharply. Their trading revenue missed estimates. However, they were able to beat earnings by massively reducing their loan loss reserves. So I just put a whole bunch of cash back on their balance sheet, right? So now their earnings look like they beat. And this is the problem when you invest.
Passive investors that just buy, that aren't really doing much homework, are in control of the market. So what does that mean? We kind of liken this to driving down the Pacific Coast Highway. If you've ever done that, it's a beautiful drive, but it's a little scary. You're on one side, you have a massive cliff that goes upward, the other side, a massive cliff downward to the ocean. You got brakes on your car, thankfully, but the guardrails are ultimately there to make sure that if something happens, you stay on that road. We can think that as this passive active thing, it's the same thing, that we've probably gone to the point where there are no guardrails. So the market can go up the left, up that steep cliff. Market can go well beyond where we think it can go, but it can also go down to the ocean because there are no active investors to play the role that they typically play in regulating valuations.
Well, and we saw that back in March. One of the differences in March is, look, we've had corrections and bear markets before, but one of the kind of telltale moments of this, and we've written about the risk of passive investing, is that passive investing is fine until they all become active sellers at the same time. And, this is the thing people forget is like, oh, I'm buying a passive index. I'm just going to buy it and hold it. And you'll do that until the market declines enough that you sell it. Everybody in their family has some part of their family that you don't get along with, right? It's the one guy or girl that's like, oh my God, is June coming this year or Bob? It's that Thanksgiving stress, right? And I mean, I've got a couple of brother-in-laws that, I can, certainly avoid. It's not a problem. You have anybody in particular?
Yes.
Well, Dr. Fauci's doing us a favor this year. He says that Thanksgiving family reunions are off.
Really?
Yes, off because of the coronavirus. So you can't have your family gathering this year. So,
but isn't Thanksgiving after Election Day?
It is.
I'm telling you, it's going away. November 4th, it goes away.
November 4th, coronavirus goes away. Well, Dr. Fauci says, no thanks, so I'm being spared this year of the annual family debacle. So,
thank you, Dr. Fauci.
Exactly. He gets my vote for president. I'm writing Dr. Fauci in now for president.